Central banks around the world have been accumulating gold at record levels, purchasing over 1,000 tons annually in recent years, which represents roughly double the pace from just a decade ago. That's not speculation or conspiracy theory. That's documented behavior from the institutions that print the money. When the organizations controlling the world's currencies start hoarding a 5,000-year-old asset at unprecedented rates, you should probably ask yourself what they're seeing that the average investor isn't. Today, we're breaking down exactly why central banks are stockpiling gold, what this institutional behavior signals about the future of the dollar and the global economy, and what all of this means for your portfolio. The scale of this buying is remarkable once you look at the actual numbers. Over 1,000 tons annually represents the current pace of central bank gold purchases, and that's roughly double what these same institutions bought during the 2014 to 2016 period. This isn't a slight uptick in demand. A fundamental shift is underway in how the world's monetary authorities allocate their reserves. Poland, China, and India are leading this charge. And here's the number that puts it in perspective. Gold now represents approximately 20% of global reserves, which is a massive allocation to an asset that pays no interest and generates no yield. Retail investors buying gold can be dismissed as fear-driven or speculative or just following some newsletter's advice. Central banks don't operate that way. Teams of economists and analysts staff these institutions. They access data the rest of us never see, and they think in decades rather than quarters. That's what makes this behavior worth understanding. When these institutions collectively decide to accumulate thousands of tons of gold year after year, something is driving that decision. Gold has served as money for roughly 5,000 years, and that history carries more weight than most people realize. Every paper currency in history has eventually failed or suffered dramatic devaluation. The Roman denarius went that route. So did the German mark. The Zimbabwe dollar became worthless in living memory. Governments facing fiscal pressure inevitably print more money, and that printing dilutes the value of existing currency every single time. Gold can't be printed, and no committee decision can create more of it. Mining adds roughly 1 to 2% to the supply each year, which runs slower than most central banks expand their money supply. Physics built this scarcity into the element itself. Central banks understand this history better than anyone because they're the ones doing the printing. They know exactly how much currency they've created and how much they might need to create in the future, which means their gold buying is essentially them hedging against their own policies. Gold's track record during market turmoil explains a lot of the institutional interest. Here's the number that matters. During the 2007 to 2009 financial crisis, gold rose over 25%, while stocks fell nearly 57%. That's not a small divergence. That's gold doing exactly what it's supposed to do, holding value and appreciating while other assets collapse. This pattern has repeated across multiple crises throughout history. When confidence in financial systems wavers, money flows toward assets that don't depend on counterparty promises. And gold represents the ultimate form of this because it's just metal. No bank needs to honor a commitment. No government needs to remain solvent. The institutions buying gold right now lived through 2008. Many of them stood on the front lines of that crisis, watching the financial system nearly collapse. That experience shaped them. Institutional memory drives behavior. When you've seen how bad things can get, you prepare differently than someone who's only read about it in textbooks. A larger story is unfolding beneath the surface of central bank gold buying, and it involves the U.S. dollar's role in the global financial system. Dollar dominance has been declining for decades. The currency's share of global foreign exchange reserves stood above 70% in 2000. Today, that number sits closer to 57 to 58%. Still dominant, but the trend moves in one direction. Several factors drive this shift. Weaponization of dollar-based sanctions has made some countries nervous about holding assets that U.S. policy decisions can freeze. The U.S. national debt, now at approximately $37.3 trillion, raises questions about long-term fiscal sustainability. Emerging economies want alternatives that don't depend on American monetary policy. Gold offers something no currency can match: neutrality. No country owns it. Sanctions can't touch it. Another nation's central bank can't devalue it. For countries looking to diversify away from dollar dependence, gold becomes the obvious choice. None of this means the dollar is about to collapse. The currency still dominates roughly 88% of foreign exchange trading, and no viable alternative exists yet. The Chinese yuan represents only 4 to 7% of global trade. The euro carries its own problems. But the direction of the trend matters. Even if the destination remains decades away, central banks are positioning for a world where dollar dominance gradually erodes, and gold sits at the center of that positioning. Institutional interest in gold extends beyond central banks to major financial firms. J.P. Morgan has forecast gold reaching $5,000 per ounce by 2026. When one of the largest banks in the world makes a prediction like that, it carries weight, regardless of whether you agree with the specific number. The exact price target matters less than what it represents. Mainstream financial institutions are openly bullish on an asset that traditional portfolio theory treated as a relic for decades. The narrative has shifted. Gold is no longer dismissed as a barbarous relic that pays no dividends. Portfolio insurance in a world of monetary uncertainty is how institutions increasingly view it. Gold doesn't pay dividends. You buy it, it sits there, and it generates no income. For yield-focused investors, this seems like a fatal flaw. But this objection misunderstands what gold is for. Gold isn't competing with dividend stocks for income generation. Insurance and wealth preservation are its competitors. You don't buy homeowners insurance expecting it to pay dividends. You buy it because it protects you when things go wrong. Total return over full market cycles, including the crash periods when everything else falls, is the proper way to evaluate gold. During the 2007 to 2009 crisis, dividend-paying stocks got cut in half along with everything else. Gold rose over 25%. Zooming out and looking at gold's role during the worst moments in market history makes the lack of dividends less relevant. An asset that goes up when everything else goes down carries value that doesn't show up in a yield calculation. Central banks understand this framing. Yield isn't why they're buying gold. What it does when the financial system comes under stress is why they're buying. Here's what makes central bank gold buying particularly meaningful as a signal. These institutions hold information advantages that regular investors don't have. Economic data crosses their desks before publication. They know what other central banks are planning. Government finances reveal themselves to these institutions in ways the public never sees. When these institutions change their behavior dramatically, it reveals something about their expectations. The shift from modest gold buying to record accumulation didn't happen randomly. Their assessment of the risks changed. You don't double your gold purchases because you think the future looks stable and predictable. You double your gold purchases because you're preparing for scenarios where stability breaks down. The gold buying functions as the tell. These institutions are showing you through their actions what they actually believe, regardless of what their public statements might suggest. Central bank gold buying isn't happening in isolation. Other indicators point in similar directions. The Buffett indicator, which measures total market capitalization relative to GDP, currently sits at approximately 220%. That's deep in territory analysts describe as significantly overvalued. Around 39 to 40 is where the Shiller-Cape ratio hovers, measuring cyclically adjusted price to earnings. Those levels approach what we saw at the peak of the dot-com bubble. The yield curve carries an almost perfect track record, having predicted every U.S. recession since 1955. The recent inversion stretched longer than any since 1978. That inversion is now normalizing, which historically marks when recessions tend to begin. Warren Buffett sits on the largest cash pile in Berkshire Hathaway's history. When the most successful investor of all time refuses to deploy capital and central banks hoard gold, that's two independent signals pointing the same direction. Each indicator alone might be dismissed as noise. Together, they paint a picture of institutional caution that demands attention. Several approaches exist for adding gold to your portfolio, each carrying different trade-offs. Physical gold gives you direct ownership with no counterparty risk. You hold the metal, it belongs to you, and no institution needs to remain solvent for you to access it. Storage costs, insurance considerations, and the premium you pay over spot price when buying coins or bars represent the downsides. Convenience and liquidity come with gold ETFs. Buying and selling happens with a click, and storage isn't your problem. The trade-off is that you own shares in a fund rather than actual metal. Some investors prefer funds like PSLV that are fully backed by physical metal over funds that use derivatives or leverage. Mining stocks give you exposure to gold prices with potential leverage to the upside. When gold rises, miner profits can increase dramatically. Company-specific issues like management quality, operational problems, and political risk in the countries where they operate represent the risks. Different purposes call for different approaches, and many investors use a combination depending on their goals and concerns. How much gold you should own doesn't have a universal answer. Traditional portfolio theory often suggested 5 to 10% as a diversification measure. Some gold advocates recommend much higher allocations. Central banks, with gold at 20% of global reserves, have made their own statement about appropriate sizing. Your time horizon, your other holdings, your income stability, and your personal assessment of systemic risks all factor into the right allocation. Someone with a pension and stable job might need less crisis insurance than someone whose wealth sits entirely in volatile assets. Having zero allocation is harder to argue for. Gold's crisis performance, up over 25% during 2007 to 2009, while stocks fell nearly 57%, makes a compelling case that some exposure provides valuable portfolio protection. Central banks aren't going to zero. They're going to 20% and climbing. That institutional vote of confidence in gold's role deserves consideration, even if you choose a more modest allocation. Here's the challenge with gold as an investment. Insurance feels like wasted money right up until you need it. When markets rise and optimism runs high, gold often looks boring compared to stocks making new highs every month. This is exactly when most people reduce their gold exposure or never build it in the first place. They sell the insurance during calm weather and then have none when the storm arrives. The investors who benefit from gold's crisis performance owned it before the crisis, not the ones who tried to buy as everything fell apart. By the time headlines turned scary, gold has often already moved. Central banks understand this timing problem, which is why they accumulate steadily over years rather than trying to time their purchases. They're not predicting exactly when the next crisis will hit. They're making sure protection sits in place whenever it arrives. Let's return to the question in the title. What do central banks know that's driving this behavior? History is what they know. Every fiat currency eventually loses purchasing power. Governments under fiscal pressure print money. Central banks know this because they're the ones doing it. They know the global monetary system is evolving. Dollar dominance gradually declines. New power centers emerge. The financial architecture that's existed since World War II slowly shifts. Tail risks exist, and central banks know it. The 2008 crisis happened. The pandemic response required unprecedented money printing. The next shock, whatever form it takes, will require more of the same. Each intervention makes the currency worth a little less. They know that gold has maintained purchasing power across civilizations and centuries, while every paper currency they've ever issued has eventually approached zero. That knowledge, combined with access to information we don't have, drives them to accumulate gold at record rates. Their actions reveal what they think is coming, even if they can't say it publicly. Over 1,000 tons of gold annually, roughly double the pace from a decade ago, with gold now representing approximately 20% of global reserves. That's what central banks have been buying in recent years. These institutions don't buy on emotion or speculation. Analysis, access to privileged information, and time horizons measured in decades drive their decisions. When they collectively shift their behavior this dramatically, it reveals something about how they view the future. During the 2007 to 2009 financial crisis, gold rose over 25%, while stocks fell nearly 57%. That crisis performance, combined with concerns about dollar dominance, fiscal sustainability, and monetary policy, explains why central banks are hedging their bets. Perfectly timing your gold purchases or predicting the exact moment of the next crisis isn't the question. Whether you want to own some protection before it's needed is the question, the same way central banks clearly do. They're not waiting to see what happens. They're positioning now. The gold purchases tell you what they actually believe, regardless of what any official statement might suggest. What you do with that information is up to you.